All right. So majorly today we'll be looking into structure. All right. So majorly today we'll be looking into structure. What part of structure are we trying to talk about here? So the first thing we want to look at is the theoretical part of structure. Okay. Everything has a structure. What is it called? Every business has a structure. In fact, things have their own structure differently, be it cars, as in the example that I shown. So for example, if initially when these cars, when they were covered, okay, you can't accurately differentiate them. You cannot accurately say that this is how fast you get to your destination or stuff like that with any other factors that you can't determine the moment that the two cars were actually covered. Okay. So, but it is the structure after being unveiled that lets you understand, oh, this is a sports car, this is this and no, and that will give you insight of which will be faster, which will accelerate faster in order to get to the destination at hand. Okay. So structure is very important. Same thing in the market generally. So everyone calls us forex traders, forex trader. Majorly, I would say I'm a forex trader because, of course, I trade currency pairs majorly. But it is not everybody that is a forex trader. Okay, at times I'm just not. I'm not only a forex trader. Why? Because at times I may decide to go to BTC, analyze it, trade it. Meanwhile, BTC is not a forex market. In fact, gold is not a currency pair. Okay, so but everything is majority of the volume is put under the whole foreign exchange thing. Okay, so we have indices, we even have synthetic indices and all of that. So it is not everything that you want to just put under forex. But meanwhile, everything that you will learn here is everything you need to actually analyze any trading chart, be it crypto charts, synthetic indices, and all that. There is absolutely no difference. Okay. The only difference you can encounter if you want to delve into being a synthetic trader is time. That's it. And all you need to do is just to backtest and actually just look at the particular time that can actually work for you to actually trade. That is the only difference. But structure wise, price action, delivery wise, and everything you will learn will help you to actually analyze any market, okay, that you want to actually analyze. All right. So, for example, in this example, we are trying to let you understand that stock markets exist to what? To create wealth. That is just the truth. That is why they are usually bullish overall. S&P 500, Dow Jones, that is US 30. If I open US 30 for you on weekly time frame, you see that overall it has been bullish. Okay, so stock markets are majorly designed for profitability. So generally, the general bias is usually bullish, unlike some currency pairs that you will see from the very time that they've come into existence, they have been going down. Okay, so that's it. That is what they are, and they are less risky in the real sense. I mean, for people that trade them in form of physical asset, people that buy and store for a long time and all that, so they are quite less risky to actually trade. But another thing to note is that the stock market is less volatile than forex market. Forex market is the most volatile market in the world. Okay, so stock markets exist to create wealth. They are entirely speculative. Of course, all participants have the same motivation, which is what? To make profit. So you see people, even old people, old and young and all, you see everyone saying, oh, I'm into stock trading, I buy social. In fact, it's becoming more common these days, even among youths, even here in Nigeria, whereby before people don't do that. It's only old people that I know before that deal with stock and all. But it's quite interesting to see some young people now also, at least, if not forex, purchasing stocks and all that, investing into the stock market and trying to make profits in the long run by holding. Okay, majorly by holding. Okay, so that is majorly the thing. So the stock market exists to create wealth. So, but In the opposite sense, how is forex market designed? Forex markets exist to provide a service. They are mostly utilitarian, of course. Participants have different motivations and what an objective. That is it. So the forex market is majorly to create what is to create it exists to provide a service. Okay. By the time we get to liquidity, I'll be explaining more on that, whereby we have the market maker coming into place, serving as an exchange means, selling liquidity. The market maker majorly is the provider of liquidity. If I scroll through and show you the liquidity part of things, you will understand what I'm trying to say better. So you see all this, you can see buy 100 million and all that. You will see more of that. You can see everything. So imbalance and order flow, liquidity and all that, they will explain better everything I would like to talk about how the back end of the forex market actually works. Okay, so this is what I'll be using to explain when do you have a movement, when don't you have a movement. Okay, price will move in direction of least liquidity relative to what? Relative to demand. So it is always demand in place. It is always demand in place. In fact, in every market, even in economics, everything, supply is happening in relation to what? To demand. The supply is not, let me say, independent on your own. So everything you are measuring in economics majorly, you are measuring in respect to demand. That is just the obvious truth relative to demand. If you are an economist here, you can prove me wrong, but to my best understanding, I think that is how it works. Okay. So all these things will actually be discussed in full notion. Of course, by weekend, we should be done with everything that we are doing, either we like it or not. Okay, so majorly, that is structure. So structure helps you to have better view of things. Don't mind all these people you see online that are telling you structure is no longer king. Though I'm not here to tell you that structure is king or is not king. What I'm trying to let you know is that you have to understand structure. That's it. It doesn't make any sense. Even as a businessman, you have to have a good structure in place to actually do well in your business field. Even personally, I'm still struggling with trying to mold in some structure in order to perfect my business. Do you understand? So structure is very important in anything, in sales, to even make good sales or anything at all. So you can't just neglect structure and you just think there is one holy grail out there that is telling you that you should neglect structure or you should not. So it makes no sense. That's what I'm trying to tell you here. Okay, so that is structure for you. In the research, nothing much to talk about than to majorly go into the chart and look at the order of things that we have forward for today. Okay, so I'll be switching in a moment. So let me open syllabus down right in front of me so that we can take it step by step. Okay, so let me. All right, so the first thing we have here is to talk about the characteristics of structure. Okay, so that is the first thing we have to talk about. Characteristics of structure. All right, so what are the major characteristics we want to look at? So number one, we want to look at what we call major liquidity and external liquidity. Major liquidity and external liquidity. Okay. So we want to look at structure range. Okay, so those are the first two we want to look at. Major liquidity and external liquidity, then structuring. Okay, so in a bullish environment, for example, Okay, if we say that market is bullish, structure-wise, how do we know that market is bullish? Structure-wise, we know that market is bullish by series of higher highs and lows that it makes. That is higher swings, either higher high or higher low. So our swing high and swing low. What do we even call swing high or swing low? Let me go lower into so that you guys can understand things better. When we're talking about swing low, a swing low is majorly when you have three candles, okay, or three or more candles surrounding each other. Okay, so a swing low majorly is the one with the lowest wick. Okay, so what do I mean by that? So something like this. So let's say we have this, and then we have this. Okay, so a swing low majorly is this low, this wick right here, the wick of this low. So that is a swing low. So more like a V-shaped thing. So these are swing low, this wick right here. Okay, so same way for a swing high. Irrespective of the type of candle that is there. Okay. So for a swing high, this is our swing high. Okay, so and you will come to appreciate that later in the class after we actually use it under liquidity for rates and the likes. Okay, so for a bullish structure is the type whereby price keep making series of a low, that is a swing low, a high, then a higher swing low, which we simply call higher low, higher high, higher low, higher high, higher low, higher high, etc. So that is a bullish what? That is a bullish structure. So, and a bearish structure majorly, for a bearish structure is the one whereby we have series of lower lows and highs. So we have a high and a low. So lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So those are what? Those are majorly the things. So low, high, low, high, low, high, low. High, low, high, low, high, low, high, low, high, low. So a bullish scenario, we have series of, so we say this is an uptrend generally, and this is a downtrend. Okay, so for an uptrend majorly, a swing high, low, higher low, higher high, higher low, higher high, low, high, low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, then lower low. Is that understood? Okay, so having understood this, in a bullish environment, you expect the highs to be rated. In a bullish environment, that is price, we call it continuation break of structure. Price break structure to the upside to continue the bullish movement. Okay, so it breaks structure to create a new high, break the new high to also create a new high, break the new high to also create a new high. So in a bullish environment, majorly, we expect price to keep raiding what? We expect price to keep raiding the highs, okay? And in a bearish environment, we expect price to keep what? Raiding the lows. So BMS to the downside, BMS to the downside, continuation BMS to the downside, BMS to the downside, okay? So we expect price to keep breaking the what? The lows in a bearish environment. Okay, so having understood all this, then the next thing is, what do we now call major liquidity and external liquidity? You will notice that in a bullish environment, the lows are not being broken. In a bearish environment, the highs are not being broken, okay? Therefore, what are being broken in a bullish environment, that is the highs, are what we call external liquidity. So this is external liquidity. Okay, external liquidity. External liquidity. Okay, so, but the lows are protected. Those lows that are protected is what we call major liquidity. So this low right here, major liquidity, ML, major liquidity, major liquidity. Same thing in a bearish environment, the lows that are broken, the lows are the one being broken, so we call them external liquidity, EL, external liquidity, EL, external liquidity, EL, external liquidity, EL. While the highs are protected, they weren't broken, therefore, we call them major liquidity, ML, major liquidity, ML, major liquidity, ML, major liquidity, ML. All right, so external liquidity, external liquidity, external liquidity, major, 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 external, 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 major liquidity, major liquidity. So that was all about major liquidity and external liquidity. That is as simple as it is. So everything we are doing now is just identification, nothing complex. Okay, nothing complex, and we'll still show everything on chart, right? Okay. So having understood that, so the next thing we want to get to understand is structure range. Okay. Now, what is our structure range? Okay. Our structure range is, now in a bullish environment, you will notice that we have minor structure that are also in that direction. A bullish structure is majorly showing us an uptrend, while a bearish structure is majorly showing us a what? A downtrend. Okay. So, however, there are some minor trends which are also bullish trend. There are some relative minor trends which are also what? Bullish trend inside a bullish structure or order flow. So that is, it's more like checking corresponding lower time frame. Let's say, for example, this particular structure we view here is on weekly time frame. So it means that all these one inside, like this impulse here, is also a bullish trend on a certain lower time frame. So it will show clean as a bullish trend on a certain lower time frame. Therefore, those trends that are in direction of the major trend is uptrend. Therefore, the movement that are also in direction of the trend is what we call structure range. That is movement from point A here to point B is what we call structure range. This range here, it is a range. A range simply means distance between two points. That is majorly that is the simple definition of a range. A range here does not mean consolidation. There is difference between a range and consolidation in my mentorship. So don't confuse it. Don't call them the same thing, please. So a range here is simply telling you that point A to point B, the distance between them. That is normal definition, even English-wise, of a range. So a range is trying to tell us that the distance between point A to point B, this movement in direction of the trend. This guy right here, okay, structure range, we have two types of structure range. Sorry, I forgot to say that. We have the major structure range, and we have the minor structure range. So we have the major structure range and minor structure range. This range between A and B that are in direction of the trend, we are normally bullish, right? So, and they too, they are bullish movement. Okay. So those guys, A to B, is what we call major structure range. That range is a major structure range. Major structure range. Okay. So that's a major structure range. That is this point to this point as well. AB. Let me just give them the same name. AB, and AB. They are all major structure range. This range right here, major. Okay. What is now our minor structure? Our minor structure range is the pullback. That is the movement against the trend. The movement opposite to the major trend that we have. The major trend that we have is uptrend. Therefore, the movement opposite to the major trend are the what? are the pullbacks there, isn't it? They are the pullbacks there. So for example, let's call this CD, CD, CD. Okay, so these CDs between point C to point D, this guy right here. Okay, let me give that another color. Okay, these red guys right here, they are the what? Minor structure range. In opposite direction of the what? Of the trend. They are the minor structure range. Same thing here. The pullbacks here are the minor structure range. Okay. They are the minor structure range. Why this guy here are the major structure range? Let me give that green. Okay. The green guys, they are the major structure range. The green guys are the major structure range. Major structure range. Okay, so that is structure range. Major structure range, minor structure range, major liquidity, external liquidity, all has been discussed there. Any problem with that? Can we proceed? Do we all understand that? Do we all understand that? Before I proceed, I will show you examples on chart. But before that, do we all understand? All right, great. So we're all on the same page. All right, great. So let's proceed. So quickly, let's look into examples on chart. Let's look into examples on chart. So let me use a weekly time frame. Okay, so for example here, we have a bearish movement to the downside. Okay, so what do we have? We have, let me use this guy. So we have a high, okay. What's happening? Okay, I guess that will stress me a little. Let me use this. So we have what? We have a high, right? A low. Then we have a lower high, lower low, lower high. Is this the lower low? Is this a lower low? Is this low lower than this low? No, right? This low is not lower than this low, right? Hello, are you guys with me? All right, so it's not so it is not your lower low. So please don't do that mistake when you are doing your assignment. Okay, so this is your new low, lower low. Okay, then if this has already created, okay, this already created a lower low, so this will be our lower high, lower low, lower high, then lowest low so far. Okay, so that is it. So we have been bearish. So we have a high, a low, lower low, so lower high, lower low. Okay, let me pick this again. So high, low, lower high, lower low, lower high, lower low. Okay. Then, sorry, lower low, lower high, lower low, lower high, then lowest what? Lowest low. Okay. So that is majorly our structure. So we are clearly bearish. We are clearly in a downtrend. We are clearly in a downtrend. Okay. Now, what is our major liquidity? Our major liquidity is this high here, the highs that are protected. Major. Okay. So major liquidity ML, ML, right? ML. Okay. So this is not ML. This is internal structure. This guy is found inside this. It is not it wasn't created by a lower low. Okay. So then we have our EL, external liquidity, EL, 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 EL. So those are our external liquidity. So what is our major structure range? Our major structure range is within this high to this low. Okay, so we have less than a minute. You guys should rejoin to the same link almost immediately. Okay.